Picture this. While you were sleeping last night, someone in Tokyo just made more money in 8 hours than most Americans make in a month. And they did it using a strategy that 97% of US investors completely ignore. What if I told you that by the time this video ends, you'll know exactly how to tap into the same wealth-building opportunities that the ultra-rich have been quietly using for decades? Here's something that might shock you. The United States stock market represents only about 55% of the world's total market capitalization. That means nearly half of all investment opportunities exist outside American borders. Yet the average US investor puts less than 5% of their portfolio into international investments. Think about that for a second. We're literally leaving money on the table while entire economies boom around the globe. But here's where it gets really interesting. Remember the dot-com crash of 2000? While the Nasdaq plummeted 78%, emerging markets actually gained money. Or take 2008, when US markets were in freefall, some international markets recovered faster and stronger than anyone expected. The wealthy didn't just survive these crashes, they thrived because they understood something most people don't. True wealth isn't built in one country, it's built across continents. Now before you start thinking this is some complicated strategy reserved for Wall Street insiders, let me stop you right there. What I'm about to share with you is so simple that you could literally start implementing it today with as little as $50. But first, let me ask you something. Have you ever wondered why your financial advisor never mentions international investing? Or why most retirement accounts are stuffed with nothing but US companies? The answer might surprise you, and it's costing you more than you realize. See, there's this thing called home bias, and it's probably sabotaging your financial future without you even knowing it. Home bias is when investors overwhelmingly favor their own country's investments, even when better opportunities exist elsewhere. It's like only shopping at one store your entire life while amazing deals happen at every other store in town. The psychological comfort of investing in familiar companies like Apple, Microsoft, and Amazon feels safe. But safety and wealth building don't always go hand in hand. Let me paint you a picture of what you're missing. Right now, as we speak, there are technology companies in South Korea that are revolutionizing artificial intelligence. There are renewable energy firms in Denmark that are literally powering entire countries with wind. There are consumer goods companies in India serving a middle class larger than the entire population of the United States. These aren't risky penny stocks or speculation plays. These are legitimate, profitable businesses trading on major exchanges, and most American investors have never heard of them. But here's the kicker. Some of these international companies are actually growing faster and trading at better valuations than their American counterparts. While everyone's fighting over the same overpriced US tech stocks, incredible opportunities are sitting right there in plain sight. It's like there's a party happening in the next room, and nobody bothered to invite most American investors. Now, you might be thinking, this sounds great, but isn't international investing risky? And look, I get it. The media loves to make international markets sound scary and unpredictable. But let me share something that might change your perspective completely. Diversification isn't just about spreading risk, it's about capturing different growth cycles. When US markets are flat or declining, international markets might be booming. When emerging markets are struggling, developed international markets might be thriving. It's like having multiple income streams instead of putting all your eggs in one basket. Here's a real example that'll blow your mind. From 2000 to 2010, international stocks absolutely crushed US stocks. While the S&P 500 was basically flat for an entire decade, international developed markets returned about 7% annually, and emerging markets, they returned over 16% per year. Imagine if you had captured even a portion of those gains while everyone else was stuck in US-only portfolios. But let's talk about what's happening right now, because the opportunities today are absolutely incredible. China's middle class is exploding, creating demand for everything from luxury goods to healthcare services. Europe is leading the charge in green technology and sustainable investing. Latin American countries are becoming economic powerhouses. Africa is experiencing unprecedented growth in technology and infrastructure. These aren't future possibilities, these are current realities that smart investors are already capitalizing on. And here's the beautiful part. You don't need to become an expert on foreign markets or learn to read financial statements in different languages. Thanks to modern investment vehicles, accessing these opportunities is easier than ordering food delivery. But there's a right way and a wrong way to do this, and the difference could literally make or break your investment success. This is where international ETFs come into play, and they're about to become your new best friend. ETF stands for Exchange Traded Fund, And think of them as baskets that hold hundreds or thousands of international stocks. Instead of trying to pick individual winners in markets you might not understand, you can buy instant diversification across entire regions or countries with a single purchase. It's like hiring a team of experts to manage international investments for you, except it costs a fraction of what you'd pay a financial advisor. Let me give you some specific examples that might get you excited. There's an ETF that tracks the top companies in emerging markets. Another one focuses specifically on developed European markets. There's even one that invests in the fastest growing companies across Asia. Each of these gives you exposure to hundreds of companies across different industries and countries. You're not betting on one company or even one country. You're investing in entire economic regions. But here's where most people mess this up, and I want to make sure you avoid these costly mistakes. First mistake, going all in on one region just because it's hot right now. I've seen people dump everything into Chinese stocks because they heard Asia was the future, only to watch their portfolios swing wildly with political tensions and currency fluctuations. Smart international investing is about balance, not chasing the latest trend. Second mistake, ignoring currency risk completely. When you invest internationally, you're not just betting on companies, you're also inadvertently betting on currencies. Sometimes this works in your favor, sometimes it doesn't. The key is understanding this risk exists and planning accordingly. Some ETFs actually hedge currency risk for you, while others don't. Knowing the difference could save you thousands. Third mistake, and this is a big one, not understanding tax implications. International dividends and capital gains can be taxed differently than domestic investments. Some countries have tax treaties with the US that can work in your favor, while others don't. This isn't meant to scare you away, just to make you aware that a little research up front can save major headaches later. So what's the smart way to start building international exposure? Let me walk you through a strategy that even beginners can implement today. Start small, maybe 5 to 10% of your portfolio, and gradually increase as you get comfortable. Consider beginning with a broad international developed markets ETF. These typically invest in established companies from countries like Japan, Germany, France, and the UK. They're generally less volatile than emerging markets, but still give you that international diversification. Once you're comfortable with developed markets, you might add some emerging markets exposure. These are countries like China, India, Brazil, and South Africa. They tend to be more volatile, but they also offer higher growth potential. Think of developed markets as your steady foundation and emerging markets as your growth accelerator. Here's a pro tip that most financial advisors won't tell you. Consider adding some sector-specific international ETFs to your mix. Maybe you believe in the future of renewable energy. There are international ETFs focused specifically on clean energy companies worldwide. Interested in the global technology boom? There are ETFs that focus on international tech companies. This lets you invest thematically while still maintaining international diversification. But timing matters, and right now might be one of the best entry points we've seen in years. Many international markets are trading at significant discounts to US markets. While American stocks have been hitting record highs, international stocks in many regions are still undervalued. It's like walking into a store where everything American is full price, but international items are on sale. Currency fluctuations have also created opportunities. A strong dollar has made international investments cheaper for US investors. When the dollar eventually weakens, which most economists expect it will, international investments could get a double boost from both local market growth and favorable currency movements. Here's something most people don't realize about international investing. It's not just about returns, it's about sleep at night peace of mind. When you're diversified globally, you're not putting all your faith in one country's economic policies, political stability, or market conditions. You're spreading your bets across different economies, different currencies, and different growth cycles. It's the ultimate insurance policy for your financial future. The wealthy understand this instinctively. Look at any billionaire's portfolio, and you'll find significant international exposure. They're not smarter than you. They just understand that the world is bigger than any single country's stock market. They think globally while most people think locally, and that difference in perspective translates directly into wealth. As we wrap up, here's your action plan. Start by researching broad international ETFs from reputable fund companies. Look for low expense ratios, strong track records, and good liquidity. Begin with a small allocation that won't keep you up at night if it fluctuates. Gradually increase your international exposure as you become more comfortable and educated. Remember, International investing isn't about getting rich quick or chasing hot trends. It's about building a more robust, diversified portfolio that can weather different economic storms and capture growth opportunities wherever they occur. While your friends and colleagues keep all their money trapped in US-only investments, you'll be positioned to benefit from global growth. The world is your investment oyster, and the pearls are waiting for those smart enough to look beyond their own borders. Your future wealthy self will thank you for taking this step today.